Before you put your money anywhere, you really should ask yourself what type of investments are available and how do they actually work? Now, fortunately, pretty much everything falls into one of three buckets. But before I get into those buckets, I want to say what I'm about to tell you is probably going to ruffle some feathers with some people. So I want to make it clear that I am not saying anything is better than the other. I'm not saying anything is good or bad. I am just providing you with pros and cons so that you understand where your money's going before you put it there. So the first category we have is ownership. And this is pretty self-explanatory. This is owning a piece of equity in a company. Public equity is what most people know. This is stocks. When you buy public stocks, you're buying pieces of companies listed on public exchanges like the New York Stock Exchange or NASDAQ. Prices are set by millions of participants every second based on all publicly available information. That's what makes public markets relatively efficient. So the price you're getting is likely a fair price. Private equity, on the other hand, is a little bit different. These are private companies not traded on public markets. There's no open auction to set the price. The business owner pretty much decides what they think their company is worth. As an investor, this might create asymmetric information, meaning that the seller might know more about the company than you do. You might get a great deal or you might overpay. So unless you have a real edge or a deep expertise, it's really challenging to know whether or not you're getting in at the right price. Next, we have lending, which is where you give someone money in exchange for that money plus interest back over time. And similarly to ownership, we have both public and private lending markets. Now, on the public side, we have bonds that are issued by governments and companies. These are traded on liquid and transparent marketplaces, generally considered to have fair pricing. Here you can see things like the credit rating, which is how reliable the issuer is in returning your money, the yield, which is essentially how much money you can expect to make from the investment, and the maturity, which is how long it's going to take you to make that money back. From there, you can decide if this fits your needs. Private credit, however, is a little less transparent. These are loans to companies that can't or don't want to borrow from traditional banks. Why? Maybe they're too risky, too leveraged, too niche. So these will pay much higher interest rates, but you're taking on more credit risk with less liquidity and less regulation. That doesn't make these a bad choice, you just have to be very selective. Lastly, there's non-economic activity investments. This is a catch-all bucket for assets that don't have any underlying cash flow or business activity. Think of things like art, wine, cars, even gold and crypto. These things don't generate earnings, pay dividends, or produce cash flows. They're simply worth what someone else is willing to pay for them. Their value is based on scarcity, sentiment, and storytelling, which means, yes, they could go up in value, but there's no fundamental way to determine what they should be worth. Not saying there's anything wrong with that, but it's important to recognize the difference. These assets are speculative and may produce some emotional or lifestyle value, but they're not always grounded in some sort of economic productivity. So whether you're buying ownership in a business, lending capital, or buying collectibles, the key is to know what you own, why you own it, and how it fits into your overall plan.